Right. Well, I'm back. Did you miss me? I didn't. Haven't done anything for about, I don't know, 3 weeks, a month, something like that. Um, just haven't felt that inspired. This is roughly where I left things off, saying really we've done, like all the equity charts, they're looking like this, right? This, the S&P weekly, going back to post GFC. So you can see really it's come back to, this is 50%, right? It's come back to that middle line. And I guess it's done a couple of interesting things. This gap here, I had my eye on for many months. That one, that's on the wide, 39.50 up to, like, 4100 or something. And I was saying, look, it's going to come back to that, which it did, and it chopped around and then it broke through, and it looks like it could actually be coming back to retest it from the downside. The next gap, which is similar to it, is down here, right, which is 35 to 36, maybe 37 on the wide. And it's looking pretty likely, actually, I think. You can see this is, post-election 2020 and vaccine news, and it did shoot up, not as rapidly as here, right? Like that was just vertical, no looking back. It's had a little bit of looking back, but you can see that when it shot through, it didn't come back and fill that gap. Like a lot of this action here, it's all overlapping, right? All overlapping. Right. This wasn't, okay, so there's a gap, so that made sense for me. That's the rationale behind that target. And this is the next one. This is a pretty good level for it to come back to, because that's the last time there was really serious dispute on the price. 50% retracement from the COVID low. And also it coincides pretty closely with a 116 move of that, 1, 2, 3 moves down. So if you believe in like Elliott wave theory, to me that looks like a clear 1, a clear 2. That's too short for a 3. So I reckon that's 1, 2. This is the third leg, and it's not finished. I guess another reading is, you could say, another reading is like it was like 1, 2, 3, 4, 5, and we're kind of done. I don't really believe that. I think it's more like 1, 2, 3, and it's probably got, it hasn't completed, hasn't finished those targets in my mind. So I think this could come back up into this level here somewhere and turn around and drop again. It is at a, just in the same way this kind of wedding caked down, and see that support there, turn around, resistance there, this support here, it could be attract selling there. If it doesn't crack this 3900 convincingly, then I reckon 3500 is the way to go. I rode this down fair way. I think I squared up at like 37.55 is where I squared up, so down here. So I didn't get the low, but I got most of that move, which was good. And the reason why I squared up was because of this. It was just heavily oversold on those 4 hourlies, and so that's when I got over. This is the cash market, not the futures, hence all the gaps. I'm not quite sure. I've got to pull up the futures rather than the cash market. Well, I'll pull up the cash market rather than the futures market. Anyway, so that's pretty much it for equities. I think it's still got some way to go. I think filling in there is a good chance. I think that 3500 is a good chance. Look, you know, I'm not sure if it'll go much lower than that. I think the buyers will come in. To me, I think that's really where it will come to. Again, the caveat being, unless there's another trigger out there. Funnily enough, I think when I was here, I said, look, I don't think it's going to go lower unless there's another clean out event, another trigger. And I said, I think the trigger is going to come from over here, which it actually did. Shitcoin. Such a joke. So this is what I've been looking at for ages, right? Where, you know, this thing, it has 85% drawdowns continually. You can measure them. That's like an 85, that's like an 85, that's like an 85. 85 from the top here takes it down to about 12,000, 11,500, 12,000. That's also the breakout level from here. This chart where, this price action where it goes up just non-stop, then plays past the parcel, then when it breaks this, it's a savage move down. I've said that like a lot, and that's of course what happened once it broke through that 30,000 level. I still think it's got more to go. This is a one-to-one wave relationship from that top at 68 down to like 32, back up here 47 all the way down. There's a few reasons why I think it's going there, and you know, if it does, one of the reasons why it's holding this level is because it goes back to there. I think it's only a matter of time before it breaks this, that kind of 19,500 level. If it breaks through that, then it is going there without a shadow of a doubt. That could drive the S&P down to like 3,200. So although I don't trade this, it is, you know, I guess a bit of a canary for risk. So that's why I do watch it. So that's the equity markets. Quick look at the Russell. So the Russell's done that same thing, shot up, past the parcel, and it came down, right? That's what Bitcoin is doing. It's just lagging. Same thing as the S&P. It's come down to roughly that middle line. It's done like a 50% retracement. Could go a little bit lower down to this point in here, but I think it's, you know, the big efforts on the move have already been done. I've actually been a little bit long equities via the Aussie market. Since the bounce, when it was down like 6,400 is where I got in, and the reason why I got in there was, again, like these 4 hourlies were just compelling. So I bought in like 6,400. It's a quite a good level, actually, almost like on the ding dong down there, right? And you can see it was oversold there on the 4 hourly. Kind of had another leg down, slightly stronger momentum there, and so for me that was a trigger to get in. Actually, this is the cash market again, not the future. So the futures are lower. There's about 100-point discount, so there was 6,400 on the futures, so it wasn't kind of ding dong on the low there. The same thing you can see here on the hourly, weakening price, strengthening momentum. So that's why I've got in. These markets, I mean, they do look like they're going to fill the gap up to here. I think there's a few more 100 points in it, so that's why I've turned around to be long, cautious long, mind you. On yields, I'm out of my short bonds, and I'm basically doing spread trades at the moment, which have been working out well. The 10 years in the US, that's hit that target. This is the 1.618 move. It hit that target and it's paused. That was my target there. So I've had some trades on where I've been long some of the shorter term bills and euro dollars and short the longer end, because those curves are heavily inverted. So the implied yield on the US 10 years is like 3.117 at the moment, 3.18. In the Australian market, the 3-month bills, like in around about this time next year, are implying over 4%. Right? They're 100 points higher. They're like 420. So when I kind of think, look, if I can buy those bank bill at 420 and sell like sell US treasuries at 320, 10 years, that's like 100 points inverted curve. So a large chunk of that is, the Aussie to US credit spread. But I see very little chance in Australian rates going higher than US rates because, well, for a couple of reasons. One, US inflation is higher than Australia anyway at the moment. But also our housing market is far, far, far more leveraged and sensitive to short-term cash rates. So it makes it harder for the central bank here to raise rates. So that's a bit of a macro high conviction trade I've got in. So I've got a fair bit on that, where I basically think that the Australian short end has oversold. The bonds have oversold, so I'm long them. I'm cautious about being outright long without being any short against it in case inflation really does get a gallop on. I don't think that's going to happen, but it's just a caution. So against that, like I'm short some of the US 10 years against it. So it's a bit of an Aussie US curve spread trade, a little bit complicated, but it's been paying off nicely. I also put a steepener on in the US 2s versus 10s when it went flat. It's kind of back to like 10 points or something like that now. Now the other thing that I've done is I've gone short copper, because when you look at this pattern, I mean, Bitcoin's a good example, right? You see it in the Russell, 2000. It goes up past the parcel, breaks down, and it's all over. You can see it in all kinds of stocks. Like, this is Peloton, shot up past the parcel, broke all the way down. Spotify's another one. They're everywhere. I've been through this before, right? But it's the same pattern where you get a big shoot up past the parcel, and then when it drops down through that neckline, it's very savage and very sharp. Now, gold, I've had my eye on to do that for a long time. I'm still short gold, in the money on that. But I'm thinking of view that it's had that big run up, passing the parcel here, and it's going to drop down. It did a little bit of a version of it here. That's actually where I shorted it, where it shot up, past the parcel, shot down. I am of the view that it's still going down. But the other one, of course, is copper. And you can see it's been doing the same thing. So when it broke through $4, that's when I shorted it. But it's done the same thing. You can see, right? This is weekly, where it shot all the way up. It's been playing past the parcel. Now, it hasn't had descending highs, which is what I normally look for. But when it broke through this level, you can see it is broken down quite savagely. It's having a little bit of a pause here. But in my mind, there's a good view. It's a good chance it's going down to $3. So I'm short that. I guess part of my view on the markets, on a macro view, is that this is what's been happening in quite a few commodities. They are the source of a lot of inflation. Those high commodity prices, they don't last. They do reverse quickly. And when they do, that will ease inflation pressures. It will mean that central banks won't have to ease as much. It will mean that the curves will steepen. It will mean that equity markets will recover. So that's my macro view at the moment. So basically the short end is overshot in bonds. The 20% correction we've had is the same correction as what we had during 2018, the last time there was a spike in in bond yields. You can see that here, there to there, right? That was 2018. So the equity markets have done their hard yards, and the bonds have overshot the mark in the short end. So my macro view is commodities are going to come off the boil, hence I'm short copper and gold. That's going to ease inflation, which is going to mean the short end bonds are going to rally. That's why I'm long those short end bonds. The curve's going to steepen. That's why I'm short the longer term bonds. And equity markets will recover, which is why I'm mildly and cautiously long equities. Now, that's my macro view, and I guess that's also why I haven't been posting much, because my macro view, it doesn't change, 10 times a day, right? It's there for the long term. Now, I guess my caveat on all of that is, like, when you look at these charts on a non-logarithmic scale, this spike is massive, and it could, just on a total gut feel, it could very easily come back to here, which is 3,400. So it could really quite overshoot. Now, we've seen a clean out, but we haven't seen what I would say is really shit scared panic liquidation yet, right? And so there is always a trigger for that. If that trigger happens, it's going down here, like definitely to this range, and possibly further, maybe even down here. It will go, so if there's a trigger that triggers some shit scared liquidation selling, then it's going down into the 3,000 or 3,500 mark, no questions asked. Where is that going to come from? As I said, Bitcoin, I think, is the place to see that action happen. When people start getting margin called on their shitcoin, they'll be margin called on their Tesla and all other kinds of things. Look, so that's pretty much where I am at the moment. I've had a good time shorting it, made money on the bonds, made money on the equities. I haven't really made much money on the currency. The Aussie's been sitting there in the doldrums. But just because the central bank has been lagging and it hasn't caught the commodities bug, which I thought it would, but it hasn't. I am thinking of winding up a bit more on it though, just on the basis of some of these moves, which are very sound in their, from this breakpoint point. One, that's wave 1, 2. Then when you kind of take it from that breakdown point here to there to here, you can see that's like a 1-to-1. So I'm thinking, just as it's done those nice fibos on the way down, it could do them on the way back. Right? That would take it to 80 cents, which, all things being equal, where commodity prices are at the moment, that is where the Aussie dollar should be. So that's really what I'm looking for, but I think it's going to take a little bit of work on the rates front for that to ease, and maybe with inflation easing, we'll see the Aussie bounce back. Look, that's pretty much it for today. I hope that's been useful. As I said, it's my style is very much like a macro approach, and so I'm really trying to. My aim in life is actually to trade less and just get those good high conviction macro trades right there, the ones that have always done well for me, as opposed to in and out punting. All right. I hope that's helpful. Have a good one. We'll catch you later. Ciao.